Today we shall be looking at taxation of specialized business. Taxation of specialized business. In tax, there are some businesses, some companies, some sectors of industries. We regard them as a specialized business because of the way that we compute their tax liability is different from the normal computation of tax liability of a company, of a manufacturing company or trading company, because of the nature of the operation. The nature of the operation make them a specialized business. So because of the nature of operations, they are specialized business. The operations are very peculiar. And secondly, why do we refer them as a specialized business? Because they operate, most of these companies operate in more than one country. Please try to mute your audio. So they operate in more than one countries. They are specialized, and the services that they render is a specialized in nature. It's not a general service. So under taxation, the following business are regarded as a specialized business. Number one, airline, shipping and telecommunication company. Airline, shipping and telecommunication company. Airline, shipping and telecommunication company, they are specialized business. Why is this specialized? Because airline company operates in more than one country. An international airline company, they operate in different countries. They can operate in like 5 countries, 10 countries. They are specialized. They will carry passengers from one country to another country. They can carry passengers from France to Nigeria. They are specialized. Shipping companies too, they are specialized in a sense that they operate in more than one country. They will carry cargo from Madrid to Nigeria. When they are going back from Nigeria to Argentina, so they operate in different countries. That makes them a specialized business. Telecommunication companies too. Telecommunication companies too is a specialized business. They operate in more than different countries. Please try to mute your audio, please. So the first, we have 5 classifications of specialized business. Airline, shipping company, and telecommunication company, they are classified as number 1 company that are regarded as specialized business. So the way with the tax computation for airline, shipping company, telecommunication company are the same. Second, banks. Banks too is a specialized business. Taxation of insurance business too. Insurance business too is a specialized business. The way we compute tax liability of insurance, we have to consider some provisions. We have to consider some guidelines. We have to look at insurance acts. You understand? In computing taxation of banks too, we have to consider how do we make provision for performing loan, non-performing loan. We have to follow some prudential guidelines, some BOFIA acts that make it a specialized business. Likewise too, unit trust business and pension fund, they are also a specialized business. Aside that, taxation of real estate business in Nigeria, real estate investment company. real estate that involve in construction of that they involve in construction of houses for sale, disposal of land. They are all specialized business. Mr. Anthony, please try to mute your video, please. They are specialized business. So this night, out of all these 5 specialized businesses, we are going to look at 2. We are going to look at airline, shipping company, and telecommunication company, number 1. And we are going to look at taxation of bank. Please try to mute your audio. Try to mute your audio. Airline, shipping company, and telecommunication company. We are also going to look at banks, taxation of banks. So these are the 2 that we are going to look at this night. Let's start with taxation of shipping, air transport, and telecommunication company. How do we compute their tax? First and foremost, airline, shipping company, telecommunication companies, their tax, they are going to pay the following tax. They are going to pay company income tax, which depend on their turnover. And they are going to pay tertiary education tax. That one depend on, so that one is 3% or 2.5% or 2%. It depends on the year of assessment. And tertiary education tax is computed on adjusted profits. Aside from paying tertiary education tax, they also pay police development levy, which is 0.005% of the adjusted profits. Aside that, telecommunication company, if their turnover is more than 100 million in a particular year, they are going to pay technology tax. That technology tax is called NICDA, National Information Technology Development Agency levy, and it is 1% of profit before tax. These are all the tax that airline, shipping, and telecommunication company will pay. Aside that, for a normal manufacturing company or trading company or service company, based on Finance Act 2019, the minimum tax rate for a company is 0.5% of their turnover. You understand? But one of the exemption that 0.5% don't apply to is taxation of airline, shipping, and telecommunication company. Their own minimum tax is 2% of their turnover, not 0.5. %0.5% of turnover apply to them as it is applied to them 2% of their turnover. So how do we compute taxation of airline, shipping, and telecommunication company? There are steps involved in computing the tax of these companies. First and foremost, we need to know that this company operates in more than 1 country. And their turnover from all the aggregation of their turnover from all the countries that they operate is called global income. When you aggregate all their turnover from all the countries that they operate together, is called global income. Some of them receive income from passenger, cargos, mails, calls. This all applicable to airline, shipping, and telecommunication company. As you all know, they operate in different countries. So when you aggregate all their income together from all the countries that they operate, that income is called global income. Now, let's look at the step involved in computing the tax liability of airline, shipping, and telecommunication company. Number one step is you need to determine the global income. You need to determine what? The global income. What is global income? Like I said, by global income means aggregation of income of the company, that airline company, their aggregated income from all the countries that they operate in a relevant year of assessment. We are asked to compute the tax liability for 2024 year of assessment. As a company, we know that we compute them based on preceding year basis. It means when we are asked to compute the tax liability for 2024 year of assessment, it means we are going to compute tax liability based on their accounts, based on their profit for 2023 year end. So by virtue of that, we need to aggregate all their income together from all the countries that they operate. So by aggregating them, we will get our global income. Step 2 is for us to determine Nigeria income. Nigeria income means the income that the source is coming from Nigeria. The income that the source is coming from Nigeria. Example, income from passenger, income received from passenger, or income earned from passenger from Nigeria to UK, income from cargo from Nigeria to Madrid, income from core from Nigeria to France. They are Nigeria income because the source is coming from Nigeria. That's Nigeria income. But income from cargo or income from passenger from UK to Nigeria is not a Nigeria income. No, because the source is not coming from Nigeria. Anything that is coming from Nigeria, emanating from Nigeria, is a Nigeria income. We need to determine that. Secondly, we need to compute global adjusted profits. We need to compute what? Global adjusted profits. Gap. How do we get our global adjusted profits? By saying global income less global allowable expenses. We minus global income from global allowable expenses. Another way that we can compute our global adjusted profit is by saying the global net profit, add back global disallowable expenses. Global net profit, add back global disallowable expenses. We will get our global adjusted profit. But the easiest way to compute your global adjusted profit is your global income minus your global allowable expenses. That is step 3. Step 4, we need to compute our global adjusted profit ratio, gap ratio. Our gap ratio is going to be based on global adjusted profit divided by global income times 100. Global adjusted profit divided by global income times 100. You get your gap ratio. The global adjusted profit you get in step 3. you will use it in step 4 and divide it by global income times 100. Step 5, you need to compute depreciation allowance ratio. In taxation of specialized business, depreciation allowance is called capital allowance. In taxation of specialized business, sometimes the question will not give us capital allowance. That depreciation that we have disallowed as a disallowable expenses will be used as a capital allowance. So if the question does not give you capital allowance, depreciation is going to use to represent capital allowance. Depreciation given to you in the question will be used to represent capital allowance. So this step 5 may not be applicable if we are giving depreciation, if we are giving capital allowance in the question. But if we are not giving capital allowance in the question, we need to compute step 5. This step 5, we want to use it to arrive at our Nigeria capital allowance. We want to compute Nigeria tax liability. We are not computing the global tax liability. The only tax liability we are concerned on now is the Nigeria tax liability. But the profit given to us, the net profit given to us in a taxation of specialized business question will be a global net profit. The turnover given to us will be a global turnover. The expenses given to us will be a global expenses from all the countries that they operate. So what we are after is for us to get the profit available for Nigeria operation and the capital allowance that is available for Nigeria operation, so that we can get the tax liability arising from Nigeria business. So therefore, step 5, we are asked to do what? Compute depreciation allowance ratio. How do we get our depreciation allowance ratio? Is by saying depreciation expenses that was charged in your profit and loss account divided by global income times 100 all over 1. Depreciation expenses divided by global income times what? 100 all over 1. Step 6 is to compute Nigeria adjusted profit. Step 6 is to do what? Compute Nigeria adjusted profit. How do we get Nigeria adjusted profit? Gap ratio, your global adjusted profit ratio, that is step 4, times Nigeria income, your gap ratio, global adjusted profit ratio times Nigeria income. You get your Nigeria adjusted profit. Step 7 is to compute capital allowance. Is to compute Nigeria capital allowance. How do we compute Nigeria capital allowance? Depreciation ratio, depreciation allowance ratio times Nigeria income. Depreciation allowance ratio times Nigeria income. We get our Nigeria capital allowance. Once we get our Nigeria capital allowance, step 8 is to determine our Nigeria total profits. How do we get Nigeria total profits? Nigeria adjusted profit less Nigeria capital allowance. Nigeria adjusted profit less Nigeria capital allowance. You are going to get Nigeria total profit. Total profit means taxable profit. When you are computing tax liability of a company, you minus capital allowance from your adjusted profit, you get your total profit. Ideally, a normal service company, manufacturing company, trading company, if you want to compute their tax liability, you start with net profit, you add disallowable expenses, you less non-taxable income, you get your adjusted profit. When you get your adjusted profit, you less your capital allowance, you get your total profit or taxable profit. That is for normal manufacturing company, service company, trading. In the case of specialized business, for airline, shipping, and telecommunication company, you have to follow the I just mentioned. Nine, so by applying the tax rate, is from your total profit that you compute your tax liability. From your total profit, you compute your liability. You compute your company income tax. Your income tax is to be based on your total profit, while your education tax is going to be based on your police development levy is going to be based on your adjusted profits. That is it on taxation of specialized business. Anytime we want to do specialized business, we must follow the followings. We must follow the step one by one. In computing their tax liability, we must follow the step one by one in computing their tax liability. Now, let's look at illustration. Let's look at illustration on taxation of specialized business for airline, shipping, and telecommunication company. Let's look at illustration. Illustration 1. Our examinable question 1. Flying Eagle Limited is a foreign airline company and has been involved in the business of transportation of passenger and goods to and from since 2010. The financial result of the company operation for the year ended December 31, 2023 are as follows. Cargo, freight, out of Nigeria. Income from cargo, freight into Nigeria. Income from passenger freight. Income from passenger freight into Nigeria. The total income is 120 million. The expenses, wages and salary, depreciation, other expenses. We have net profit of 62 million. Additional info. Other expenses include income tax provision, general provision for bad debts, donation to University of Abuja, donation to political parties, other disallowable expenses. That is how we arrive at other expenses of 17,200,000. These other expenses of 17,200,000. That is how we arrive at it. The breakdown was given to us. Note, the Federal Inland Revenue has obtained a satisfactory evidence that the basis adopted by the tax authority of the country in which the company is registered for computation and assessment of profit and loss or loss of the company engaged in airline business is not materially different from that used in Nigeria. and the relevant ratio have been certified by the foreign tax authority. You are required to compute A, the company adjusted profit. B, the company adjusted profit ratio and depreciation ratio. C, the total profit of the company for Nigeria tax purpose. D, the tax liability of the company, the relevant year of assessment. E, how will the company be assessed to tax if Federal Inland Revenue Service certify that the tax authority of the airline company, home country, compute and assess to tax the profit of an airline company on a basis not materially different from that prescribed by CETA. So let's look at the solution. Let's look at solution. The first requirement is for the what? Is to compute adjusted profit. How do we compute adjusted profit? Based on this information given to us, we want to compute adjusted profit. And like I said, based on the step I mentioned, if you want to compute adjusted profit for the first, if you want to follow the step, one of the first step under taxation of specialized business for airline and shipping company and telecommunication company is for you to determine the global income. In this question, what will be our global income? In this question, what will be our global income? $120. The global income means the income from all the country that they operate. That is our global income. This is summation of all this income. That is step 1. Step 2 is to determine our Nigeria income. From this income, all this income mentioned, which one belong to Nigeria?
$30.
45.
45. Only 45.
And 20,000, I think.
Yes, and 20,000. This income from passenger flights, they did not mention out of Nigeria. But based on your this is a question of logic. The examiner expected that since the last one, they give you income from passenger flight into Nigeria, it means this one, income from passenger flight, will be what? Out of Nigeria, which is coming from Nigeria. Examiner deliberately does not want to put out of Nigeria. But you should understand that since they are giving the one coming to Nigeria, this 20 million will be what? Out of Nigeria. So for us to get our Nigeria income, first and third, 45 and 20, which is 65. So the examiner don't want us to follow the step. The examiner scatter it for us. He doesn't want us to follow the step I mentioned. What the examiner asks us to do first is to compute adjusted profit. The company adjusted profit. They are asking for global adjusted profit. They are asking for global adjusted profit based on this financial report, based on this profit and loss account. They're asking for global adjusted profit. Based on the step I mentioned to you, if I want to get my global adjusted profit, I said my global adjusted profit, based on the step is global income less allowable expenses, which is global allowable expenses. And I also said your global adjusted profit can also be your global income, your net profit, add disallowable expenses. Now, go back to this question now. If I want to get my global adjusted profit, which is the first requirement, my global income is 120. I will now say, out of all these expenses, which one is allowed? Out of all these expenses, which one is allowed? So let's go to the solution. The heading is very important. Flying Eagle Limited, computation of tax liability for 2024 year of assessment. Based on my own solution, I compute the tax liability. I follow the step. But the examiner is asking us to do it one by one. What the examiner is asking us to do is for us to first compute what? Global adjusted profit. How do we get our global adjusted profit? I said our global adjusted profit is going to be global income, which is 120 less global allowable expenses. Out of all these expenses we have before arriving at this net profit of 62 million, which one is allowed? Wages and salary is an allowable expenses. What about depreciation? Is it allowed or not allowed? Is depreciation allowable expenses or not allowable expenses? Depreciation is disallowable
It's not allowed. It's not allowed.
It's not allowed. Other expenses, I was giving the breakdown. Out of all these other expenses, I will go and check the breakdown of other expenses. I will only pick the one that is allowed among them. Look at the breakdown of other expenses. The first one is income tax provision. Income tax, you pay income tax. You are now classifying it as an expenses. Is it allowed?
No, sir. It's not allowed.
Not allowed. Do you understand? It is not allowed. My colleague, Mr. Chris, is still going to take you company income tax. In that income tax, you are going to know example of allowable expenses, example of disallowable expenses, example of taxable income, example of non-taxable income. So, but this is an advanced taxation. In our skills level, they will have taught us disallowable expenses and allowable expenses. Do you understand? So, but Mr. Chris will also discuss more on that. General provision for bad debt. Is it allowed or disallowed?
It's not allowed. It's disallowed.
It is disallowed.
Yes.
Provision for general provision for bad debt is a disallowable expenses. Why specific provision for bad debt is what?
It's allowed.
Bad debt. If they want to test bad debt, they can test it in 3 ways. If they want to test bad debt, it can be tested in 3 ways. What are the 3 ways bad debt can be tested? First and foremost, they can ask you that bad debt written off. Bad debt written off is allowed. Bad debt written off is an allowable expenses. General provision for bad debt is a disallowable expenses. Why specific provision for bad debt is what? Allowable expenses. Do we understand? Do we understand?
Yes, sir.
Yes, sir.
So that is that. Now we are looking at the provision of other expenses. First one, income tax provision is a disallowable expenses. The second one is general provision for bad debt, which is also a disallowable expenses. Why the third one is donation to University of Abuja. The company donate to University of Abuja. Is it allowed or disallowed?
Disallowed.
Huh?
Disallowed.
Is it allowed or disallowed?
Allowed.
It's allowed.
It is allowed.
Not allowed.
When you donate to public institution, when you make donation to public institution, it is allowed. Do you understand?
Yes, sir.
Under company income tax, there are list of organizations that we can donate to. Non-profit organization that we can donate to. Do you understand? It was clearly listed. Do you understand?
Yeah.
So one of them is donation to public institution. University of Abuja fall under public institution. It's allowed. So the first is allowable expenses out of the breakdown of other expenses is donation to University of Abuja. Donation to political party, is it allowed?
No, sir, it's not allowed.
No, it's not allowed. Other disallowable expenses is not allowed. So out of other expenses, the only one that is allowed out of this 17,200,000 is 1,200,000, which is donation to University of Abuja. Now, let's look at how we compute our global adjusted profits. We said our global adjusted profit, wages is allowed. The other one that is allowed, which is donation to what? University of Abuja, is giving us 1.2 million. We will add the two of them together. When we add the two of them together, we less it from global income. Once we less it from global income, we are going to get our global adjusted profit, which is 84 million. Which is what? 84 million. Formula for getting global adjusted profit. There are two formulas. Global income less allowable expenses approach. We can use that one. You can use global income approach by using your global income by lessing your allowable expenses from your global income, which we just did now. The second approach is by saying the net profit given to you in the question. Our net profit given to us in the question is 62 million. Add back disallowable expenses. We add back what? Disallowable expenses. When we want to add back disallowable expenses, depreciation is a disallowable expenses. Income tax provision, general provision for bad debt, donation to political party, other disallowable expenses. When we add them together, we get 22 million. We add it back to our net profit. At the end of the day, we are still going to get the same amount of 84 million. So our global adjusted profit is 84 million. Our global adjusted profit is what? 84 million. That is first question that was asked. Second question, is B, compute adjusted profit ratio and depreciation ratio. Based on the step I mentioned, if you want to compute global adjusted profit ratio, I said our global adjusted profit ratio, which is GAAP ratio, is equals to global adjusted profit all over global income. And if I want to get depreciation ratio, depreciation charge all over global income. So let's look at it. My global adjusted profit ratio is 84 million. And I know that my global income is 120 million. 84 divided by 120 times 100 is to give you 70 million. That is my global adjusted profit ratio. Secondly, my depreciation ratio, depreciation allowance ratio, my depreciation charge divided by global income times 100, I will get 5%. That is it on my global adjusted profit ratio and depreciation ratio. The third question, we should compute total profit. How do I get my total profit? If I want to get my total profit, my Nigeria adjusted profit less Nigeria capital allowance. Nigeria adjusted profit less Nigeria capital allowance. So how can I get my Nigeria adjusted profit? Based on the formula I mentioned above, I said if I want to get my Nigeria adjusted profit, our GAAP ratio, if I want to get my Nigeria adjusted profit, GAAP ratio times Nigeria income. Our GAAP ratio, global adjusted profit ratio, is 70% times Nigeria income, which is 65 million. 65 million is Nigeria income. At the end of the day, my Nigeria adjusted profit is going to be 45,500,000. I want to get my Nigeria capital allowance. My Nigeria capital allowance, your depreciation allowance ratio times your Nigeria income. Depreciation allowance ratio times Nigeria income. All you need to just know is those steps I mentioned above. Just know them. Once you know them, you will get taxation of specialized business easy. So my capital allowance, Nigeria capital allowance, is 3,250,000. 3,250,000. At the end of the day, if I want to get my total profits, Nigeria adjusted profits less Nigeria capital allowance, I will get my taxable or total profit. In this question, my taxable of total profit is 42,250,000. 42,250,000. From this, I can compute my tax liability. I can do what? Compute my tax liability. How can I compute my tax liability? I will first of all compute CIT, company income tax. My company income tax is based on my total profits. And look at it. My company income tax, I use the rate of 20%. In my company income tax, I use the rate of how much? 20%. Why? Our company income tax rate depends on turnover based on Finance Act 2019. Our company income tax rate depends on what? Turnover. Our company income tax rate depends on turnover. If the turnover range from 0 to 25 million, such company is classified as a small company. And according to Finance Act 2019, a small company is exempted from payment of company income tax and education tax. So any company that has a turnover of 0 to 25 million, then company income tax rate is 0%. They are not expected to pay company income tax, and they are also not expected to pay education tax. Still on company income tax rate, if your turnover is more than 25 million, but not is more than 25 million, but not more than 100 million, which means is between above 25 million to 100 million. In that case, you are a medium enterprise, and financiers say the CIT rate, company income tax rate for a medium enterprise, is 20%. But if your turnover is more than 25 million, 100 million, sorry, you are a large company. Financiers said company income tax rate for a large company is 30%. Go back to this question. What is the turnover of this company? Is it more than 100 million? Is it less than 100 million? Who can tell me the turnover of this company?
Less than 100 million.
What is the turnover? How much is the turnover?
Oh.
The turnover will be the Nigeria what? Income. And Nigeria income is how much? 65 million. You will not base the turnover based on global income. You will say the turnover is what? Nigeria income. Abi? And Nigeria income is 65 million. Abi?
Yes, sir.
If you look at the question, Nigeria income is what? 65 million.
Yeah.
The fourth one, 45 million. The
Okay.
third one, 20 million. When you add them together, is what? 65 million. And 65 million is less than 100 million. So the company income tax rate we are going to use is going to base on what? 20%. Do we understand?
Yes, sir.
So 20% of your total profit, 20% of your total profit, you are going to get 8,450,000. Your tertiary education tax. Your tertiary education tax depends on the year of assessment. Your tertiary education tax depends on what? Year of assessment. Let me give an illustration. Let me give one illustration for your tertiary education tax for you to understand better. I'm coming. I want to open an Excel for an illustration. Year of assessment. Year of assessment. TET rates. Tertiary education tax rate. 20 19 year of assessment, TET rate is 2%. TET rate, 2%. (2020) year of assessment, 2%. 2021 year of assessment.
Sir, I can't see you, sir.
I will share it. I will still share it. Don't worry. I'm just writing it. Okay, let me share it. For 2019 year of assessment, education tax rate is 2%. For 2020 year of assessment, education tax rate is 2%. For 2021 year of assessment, education tax rate is still 2%. For 2022 year of assessment, education tax rate came from 2% to 2.5%. To 2.5%. (2023 year of assessment, education tax rate still remain 2.5%. But 2024 year of assessment, education tax rate is now what? Is now 3%. Education tax rate is now 3%. So, ladies and gentlemen, it depends on the year of assessment you are using. Look at it very well. 2019 year of assessment, education tax rate 2%, 2020 2%, 2021 2%, 2022 2.5%, 2023 2.5%, 2024 is now 3%. So if we go back to our question, this question is for which year of assessment? This question is for which year of assessment?
2023.
2023.
Year of assessment.
2024.
2024. No, company income tax is based on preceding year basis. Company income tax liability is based on preceding year basis. The tax of 2023 accounting year end is going to be paid in when? 2020 what? 4. This result given to us is for 2023 accounting year end. But the tax liability will be based on preceding year basis. The tax liability is going to be paid in 2024 year of assessment. So if you look at my solution, I can see computation of tax liability for 2020 what? 4 year of assessment. So that is the reason why I use 3% for tertiary education tax. And our tertiary education tax is based on adjusted profits. Tertiary education tax is based on adjusted profits. It's based on adjusted profit. So we know that our adjusted profit is 45,500,000. So tertiary education tax will be based on that. Our police development.
I get that. My thought is, I thought you are saying that sex education
What
is
is it?
based on. Can you hear me now? Good evening.
I can hear you.
I thought you said CET is based on the year of assessment.
Will you compute your CET based on your adjusted profit? What is your adjusted profit? 45,500,000. It's going to be 3% of 45,500,000. Do you understand?
Yes, I do. So it's the
Your
way
police
that is coming.
is going to be based on your adjusted profit. The rate for police development levy. Police development levy was introduced in 2022 year of assessment. We started charging it in 2022 year of assessment, 2023 year of assessment, and 2024 year of assessment will be the third year of assessing police development levy, which is 0.005% of your adjusted profit. At the end of the day, when you use that, you are going to get 2,275 naira. So all your tax liability, you add them together. So that is it on this question. Let's look at the second question. Habib Limited, still on airline and shipping company. Habib Limited is a foreign company involved in air transportation business. Habib Limited is a foreign company involved in air transportation business. Its aircrafts are used for cargo and passenger flights between Nigeria and Spain. The audited financial statement for the year ended December 31st, 2023, revealed the following. Income from passenger flow from Madrid to Nigeria. Income from passenger flow from Nigeria to Madrid. Income from cargo loaded into aircraft, other routes. Income from cargo flight from Nigeria to Madrid. So, ladies and gentlemen, what will be our global income in this question?
33,457,815.
Yes. What will be our Nigeria income? Our Nigeria income. Our Nigeria income will be income from cargo, income from passenger, flow from Nigeria to Madrid, which is 30,397,250. Plus what?
Income from cargo freight from Nigeria to Madrid.
We will add two of them together. That will be our Nigeria income.
Yes.
Operating expenses. We are giving operating expenses. Depreciation.
Sorry.
Sorry,
we're not adding that one in the middle. Income from cargo loaded into aircraft, other routes.
Is it from Nigeria? They have given us the one from Nigeria. Income coming from cargo from Nigeria. They have given us, we cannot say it's from Nigeria again. This company, they have two sources of income. It's either from passenger or from what? Cargo. We have seen the income from cargo from Nigeria now. And we have seen the income from passenger from Nigeria now. Abi?
Yes, sir.
Income from cargo loaded into aircraft on other route. It means from other country to Nigeria. Do we understand that logic?
Yes, sir.
Since they have given us the one from Nigeria to Madrid, the third one is from Madrid to Nigeria. The examiner want to convince us. He doesn't want to write from Madrid to Nigeria. They now write other routes. But we students should know? Because they are giving us the one from cargo from Nigeria to what? To Madrid. Do we understand that logic?
Very well, sir.
Okay.
The first question that we saw, there was something you mentioned that because the examiner did not put the way they stated it and were able to decode it, that it means of Nigeria.
Okay, the first question we saw.
Yes, sir.
Let's go to the first question we saw. Let's look at it. Look at the first question we saw. This is the first question we saw. How do we get Nigeria income? We said income from cargo freight out of Nigeria. It means that one is coming from Nigeria now, Abi?
Yes, sir.
Income from cargo freight into Nigeria. That one is not coming from Nigeria. It's entering Nigeria, Abi?
Yes.
So that one is not, this second one is not Nigeria income, Abi?
Yes.
But the third one, they say income from passenger freight. They did not mention either into Nigeria or out of Nigeria. Do we understand?
Yes.
Why the fourth one? They say income from passenger freight into Nigeria. That means since they are giving us income from passenger freight into Nigeria, that means this third one, income from passenger freight, will be from what?
From
Out of
Nigeria.
Nigeria.
Out of Nigeria. That is the assumption we assume.
Okay.
Do we understand?
Yes,
Yes,
sir.
sir.
Yes,
That
sir.
is the assumption we assume. So let's go back to the question number 2. So our Nigeria income, we have know that. So we are given an expenses, operating expenses, depreciation, staff salary, use of airport facility, accommodation for airtime crew, hotel bills for passenger, general provision. These are all the expenses given to us. At the end of the day, we are given an operating profit. In addition to the above, capital allowance were agreed with the relevant tax authority as what? 175% of depreciation. In this question, we are be giving capital allowance. And we are told that our capital allowance that we are going to use for Nigeria business is going to be 175% of depreciation. So we don't need to compute capital allowance again. We don't need depreciation allowance ratio. You don't need to compute your capital allowance, Nigeria capital allowance. You have already been given already. So now, what is the requirement? The requirement said you are required compute the income tax liability for 2024 year of assessment. Ignore minimum tax computation. You are asked to compute the income tax liability. This one, they did not separate the question one by one. They ask you to compute the tax liability. By virtue of that, you will follow the step. You will follow them step by step. Number one step, based on what I mentioned, is you need to determine your what? Your global income. If you go to the step, let's go back to the step again for the last time. We said determine your global income. That is number 1 step. Number 2 step, determine your Nigeria income. Number 3 step, compute global adjusted profit. While number 4 step, compute global adjusted profit ratio, which is global adjusted profit divided by global income. Number 5, compute depreciation allowance ratio. If you are not giving capital allowance, you can do this number 5 step. But if you are giving capital allowance, you will not do this number 5 step. You will move to number 6 step, which is compute your Nigeria adjusted profit, which is gap ratio, global adjusted profit ratio times Nigeria income. Number 7 step, compute your capital allowance. If you have been giving capital allowance already, you don't need this number 7 step. Determine your total profit. Nigeria adjusted profit less capital allowance. You get your total profit and you compute your tax liability. So go back to this question. I will solve this question based on step by step. First and foremost, this is the requirement of the examiner. We have to compute tax liability for 2024 year of assessment. The heading is very important. The name of the company is Abib Limited. The requirement of the examiner is computation of tax liability. For which of the year of assessment? 2024 year of assessment. Because the accounting year end given to us is 2023. The financial result given to us is 2023. And company income tax is computed on preceding year basis. So we are going to apply 2024 year of assessment. So this is the requirement given to us. But we are going to go to working notes. Our working note will be based on the step. Step 1 is to get our global income. Our global income, we aggregate all the income together. Our global income is 33,457,850. That is our global income. After our global income, we need to get our Nigeria income. Our Nigeria income is income from passenger flown from Nigeria to Madrid, income from cargo freight from Nigeria to Madrid. The summation of the two is giving you 26,772,250. Step 3 is to do what? Compute global adjusted profit ratio. Step 3 is to compute global adjusted profit ratio. And like I said, there are 2 ways of getting global adjusted profit ratio. There are 2 ways of computing your global adjusted profit. This is not global adjusted profit ratio. It's global adjusted profit. There are 2 ways. It's either you start from your global income less allowable expenses. In this question, let's go to this question. Let's look at those expenses. Which one is allowed for tax purpose? First, depreciation. Is it allowed? Is
No,
depreciation
sir.
allowed?
No,
No.
it's not allowed.
Staff salary income
It's allowed.
is allowed. The use of airport facility. This company, they are into airline. They charge them for using airport facility. Is it allowed?
Yes, it's allowed, sir.
It's allowed because it is used for business. There are 4 conditions of allowable expenses. Who can tell me the 4 conditions of allowable expenses?
Only reasonable.
Reasonable.
Exclusive and necessarily.
Wholly, reasonable, exclusive, and necessarily. When you want to look at some expenses, you ask yourself, is it for business? Is it wholly for business? If yes, it's allowed. Is it necessary? If yes, it's allowed. Is it reasonable? If yes, it's allowed. So the use of airport facility, is it for business? It's for business and it's allowed. Abi?
Yes.
Accommodation for airtime crew. They rent an accommodation for the airtime crew. Is it allowed? Eh?
It's not allowed. It's not allowed.
Why is it not allowed? Why is it not?
It's allowed, sir.
When you provide accommodation for your staff,
It's allowed. It's part of the
it's
cost.
allowed. It's allowed.
Okay.
It's part of the cost.
Hotel bills for passenger. Some of your passenger, some of your good passenger, you pay
It's
the
allowed.
hotel bill. It's allowed.
It's allowed.
It's allowed.
It's part of the cost, so it's allowed.
General provision. You make provision for your bad debt. General.
It's
It's
not
not
allowed.
allowed.
It's not
Allowed.
allowed.
It's not allowed.
What about specific provision?
It's allowed.
Allowed. So
It's
in
allowed.
this, the only one that is allowed, staff salary, use of airport facilities, accommodation for airtime crew, hotel bills for passenger, they are allowed. So if we want to compute our
Excuse me,
global
sir.
adjusted profit, yes,
So I have a question. Please, can you recap that 4 conditions for determining allowable expenses and allowable expenses? My network went out at that point, so I did not really capture everything.
Wholly means WHOLLY, which means the whole of the expenses. That wholly means, is it wholly for business? Is the whole of the expenses, is it for business? Or part of the expenses is for business? Take for instance, an MD, a staff of a company. Do you understand? They rent an accommodation for that staff of the company. A company rent an accommodation for their business. Inside that accommodation, they are paying a rent of 300,000. Within the premises of that accommodation, the brother to the managing director is using part of the accommodation to do his own personal business. In that case, that rent of office is not really for business. We are apportioned in that case. The only one that is for business is what is going to be allowed. The one that is not for business is not going to be allowed. Your private expenses is not going to be allowed. So number 1 condition for allowable expenses, wholly. Number 2, exclusively. Why number 3 is reasonably. Number 4, necessarily. Do you understand? Is the essence,
Yes,
is
sir.
the expense necessary? Reasonable is talking about the amount of that expenses. Is it reasonable? Take for instance, in a company have a turnover in a year. Their turnover is 20 their turnover is 65 million. In their turnover of 65 million, the managing director of the company is now saying he's collecting a director allowance of 40 million. Is that director allowance reasonable? No. Compared to the income generated by the company, it's not reasonable. So those are the conditions of allowable expenses. So go back to this question. First allowable expenses is staff salary, use of airport facility, accommodation for airtime crew, hotel bill for passenger. By adding 4 of them together, you will get 960,500. You will now minus it from your global income. You will get adjusted profit of 32,497,350. Another way you can compute your global adjusted profit is by starting from net profit. Add back the salariable expenses. Our net profit is 32,002,350. I'm going to add back the salariable expenses. In this question, we only have 2 disallowable expenses. Number 1 of them is depreciation, which is 460,000. Number 2 is general provision for bad debt. You add 2 of them together. When you add them together, you are going to get 495,000. You add it to the net profit. When you add it to the net profit, you are still going to get the same amount of adjusted profit you get above, which is 32,497,350. So you have getting your global adjusted profit. Step 4 is to compute your global adjusted profit percentage, global adjusted profit ratio. If I want to get my global adjusted profit ratio, global adjusted profit all over what? Global income. Your global adjusted profit you get in step 3 all over your global income, which is your step 1. When you do that, 32,497,350 divided by 33,457,850, you are going to get 97% as your global adjusted profit ratio. Step 5. Though the step 5 is to compute your depreciation allowance ratio. But in this question, we have been giving capital allowance again already. We don't need that depreciation allowance ratio. So we move to that step 6, which is now come to step 5, which is now note 5 in this question. Nigeria adjusted profit. How do I get my Nigeria adjusted profit? Your gap ratio times your Nigeria income. Your gap ratio, which is 97%, times Nigeria income. Nigeria income is 26,772,250. Once you do that, your Nigeria adjusted profit is going to be 26,003,678.61. Once you get your Nigeria adjusted profit, you will take it to the requirement of the question. Your requirement of the question under your tax liability, first thing you need your Nigeria adjusted profit. You need your Nigeria adjusted profit, which is this. Second, your Nigeria capital allowance. The question said our capital allowance should be what? 175% of depreciation charge. Your Nigeria capital allowance. The question said it should be 175% of depreciation charge. 175% of depreciation is 805. So you get your Nigeria capital allowance. You less it from your Nigeria adjusted profit, you will get your total profit or taxable profit of Nigeria, which is 25,198,678.61. Now, tax liability. Your tax liability. Your tax liability. Since my Nigeria income is still less than 100 million. My Nigeria income is 26,772,250. So my company income tax will still remain 20%. 20% of my total profit. So 20% of 25,198,678.61. My company income tax, I will get 5,039,735.72. My tertiary education tax is going to be based on 3% of your adjusted profit. 3% of 26,003,678.61. I'm going to get 780,110 naira 0.36. Why my PDA is going to be based on 0.005% of your adjusted profit, which is going to give you 1,300.18. So that is it on taxation of specialized business for airline, shipping, and telecommunication companies.
I have a question.
Yes, sir.
If you go up to the capital allowance,
Yes.
because the question is 175% of depreciation.
Yes.
Is it because they were not specific? Because the depreciation figure we picked is the global depreciation, not for the Nigerian operations. So why? It's because they're not specific. That is why we calculated 175% of the global
depreciation. They are referring to that global depreciation. Do you understand? They are saying that Nigeria capital allowance is 175% of the global depreciation. That is what the examiner is saying. In taxation of specialized business for airline, shipping company, and telecommunication, they will not give us Nigeria depreciation. They will just give us the global depreciation. Do you understand?
That is okay. Thank you.
So that is it for airline, shipping, and telecommunication company. Another thing you need to know for airline, shipping, telecommunication company is their minimum tax rate is 2%. And again, other thing that we need to know is sometimes FRS, the Tax Authority of Nigeria, they may not certify with the tax authority of the head office of that shipping, airline, and telecommunication company. In that case, if they believe that the basis of tax computation of the country where the head office of that airline is located is materially different from the one of Nigeria, in that regard, they will not allow them to use depreciation as a basis of capital allowance. They will not allow them to use depreciation as a basis of capital allowance. If the way that they compute tax liability in the head office of that airline company is different from Nigeria, is different from how we compute it in Nigeria. It means FRS is not certified with the way that the foreign tax authority used. We are not going to use depreciation to replace capital allowance. If they did not give us capital allowance, we assume there is no capital allowance. So that is what we need to know. So looking at taxation of
in a
specialized
note,
business,
sorry,
yes,
please.
sir.
In a note, when we started the introductory part, where they said something about that this competition is applicable if the two countries have an understanding regarding the tax, is it the tax laws now or the tax competition. So if they're not on the same page, what happens? Is it that part is not, they don't examine that part, it's not part of the examinations? If they don't agree, how would the tax now be computed for the revenue that is arising from the traffic from Nigeria?
If they don't agree,
they're not on the same page.
if they are not on the same page, it means we need to know the turnover of Nigeria. We need to know the expenses that they incur in Nigeria. We need to know the fixed asset that is qualified for capital allowance in Nigeria. Do you understand?
Yes.
That is what we need to do. This step.
Okay.
Okay.
So, yeah. Though the last question, at least, relate to what I wanted to say. This company now, are they going to file any returns with FRS, or they are relying on their global AFS so that
they will file return with, okay, continue.
So that ICANN don't catch us unaware presenting what they file with FRS and what they file globally. So is it one single account that they are presenting, the global account, nothing filed with FRS?
The account that they will file with FRS is the tax that we computed. That tax that we computed is what they will file with FRS. That tax liability that we computed is what they will file with FRS. Do you understand? Since they operate in Nigeria, they will file return with FRS. Do you understand? The tax that we just computed is what they will file and pay to FRS.
Okay.
Do we understand?
Yes, thank you.
Okay. So that is that. So we have looked at airline, shipping, and telecommunication company. The second one is taxation of banks. Taxation of banks. How do we tax bank? How do we tax bank? Taxation of bank. How do we tax bank? Taxation of bank. Bank are subjected to tax in the same manner, in the same way and manner in which other incorporated companies are liable to tax. Bank too is liable to education tax. They are liable to company income tax. They are liable to police development levy. Aside that, bank is also liable to technology tax, which is NIDA. Technology tax. Bank is also liable to that. However, the way bank file their return is different from the way company file return. Company, if they want to file company income tax return, they will file annual return. Bank, they file monthly return to FRS. They also file annual tax return. What monthly return does bank file to FRS? Every month, banks need to be filing returns about their customer, those who open accounts with them, companies that open accounts with them. They need to file return about them. What kind of return? By providing the tax identification number of those companies that open accounts with them every month.
Yeah.
Every month. It is required that bank must submit the tax identification number of both their new and existing customer to the tax authority. Another thing we need to know under bank is, for a microfinance bank are exempted from charging VAT on their services. If microfinance bank, you open an account with microfinance bank, if they want to charge you bank charges, microfinance bank cannot add VAT to it. They are exempted from charging VAT for any service that they render to their customer. So they don't charge VAT. Aside that, at the end of every month, banks, they need to be filing return about the name, address of their new customer in the preceding month. What we mean by that, within 7 days of the following month, bank need to be filing return about their new customer. Try to mute your audio. Bank need to be filing return about their new customer that will indicate the name, address of their new customer in the last month. Please try to mute your audio. So, what are the income of a bank? What are the income of a bank? According to IFRS 15, income of a bank can be from account and transaction fee, advisory fee, underwriting fee, management fee, admin fee, insurance fee, account maintenance fee. Aside that, bank also receive income from interest, which is their major interest, which is their major income. Do you understand? Which is their major income. The major income of a bank is interest income, while other income are stated below. The other income are advisory fee, management fee, account maintenance fee, insurance commission. All these are other income. But the major income of a bank is what? Interest income. The major income of a bank is what? Interest income. However, this interest income, some of those interest income earned by bank may not be subjected to tax. They are exempted from tax. It is not every interest received by bank that will be liable to tax. Some of the interest earned by bank, some of them are exempted from tax. Let's look at those interests earned by bank that are exempted from tax. Number one interest earned by bank exempted from tax are interest on loan granted by bank to a company for manufacturing goods for export. What we mean by that is interest received by bank from loan granted to a company engaged in manufacturing goods for export. A company was set up to be producing goods that they will be exporting out of the country. If a bank gives them a loan, the interest that bank receive from such loan will be exempted from tax, subject to the following condition. Subject to what? The following conditions. What are the conditions? Number one condition is the beneficiary company, which is that company engaged in export business, manufacturing goods for export. The beneficiary company must exported not less than 50% of its manufactured goods, and such goods must not be re-exported back to Nigeria. What we are saying is that company, for the interest to be exempted from tax, that company must engage in export business, and any good that they produce, they must export at least 50% of it outside Nigeria. To outside Nigeria. They can sell 50%, less than 50% in Nigeria, but more than 50% of it must be exported outside the country. Government, the reason why government don't want to exempt, why government want to exempt interest earned by bank from loan granted to a company engaged in manufacturing goods for export, why government want to exempt them from tax, is because they want to encourage exportation. They want to encourage that we should be exporting. They want Nigeria to be an export-oriented countries. Nigeria should be producing goods that will be exporting. By exporting, it's going to add it to our GDP. It's going to make our currency to have more value against foreign currency. So one of the conditions is the beneficiary company, such company, must export not less than 50% of the goods manufactured. Second condition is the beneficiary company must obtain a certificate of export. The beneficiary company must obtain what? A certificate of export issued by what? Nigeria Export Processing Zone. Issued by Nigeria Export Promotion Council, sorry. That company that is engaged in exportation business, that normally manufacture goods in Nigeria, exporting it to other countries. Before they started business, they must register with who? Nigeria Export Promotion Council. And Nigeria Export Promotion Council must give them what? Certificate of exports. The third condition is the rate of exemption shall be below. The rate of exemption depends on the repayment period of such loan. The rate of exemption depends on the repayment period of such loan. If a company that engage in manufacturing goods for export obtain a loan from bank and is going to pay back for less than 2 years, do you understand? Such loan will not be exempted from tax. Such interest received from such loan, the interest received by bank from such loan will not be exempted from tax. Everything will be taxable. Everything. Assuming bank receive interest on a loan granted to a company engaged in manufacturing goods for export, they receive interest of 300,000. And that loan, the company will pay back for less than 2 years. It means that 300,000 will be subjected to tax. It will not be exempted from tax. So the rate of exemption shall be nil. But if the loan is between 2 to 4 years, if the company want to pay back 2 to 4 years, and the moratorium period means grace period. Grace period means when you obtain a loan, they may give you a grace period that for 6 months or for 2, you will not pay back the principal and interest. You will not pay back. It is after the grace period you start paying back the principal and interest on the loan. So if a bank give a manufacturing good for export, an exported company, a loan, if the repayment period is between 2 to 4 years, provided that the moratorium period is not less than 12 months, the rate of exemption out of such interest on loan will be 10% of such interest on loan will be exempted. Assuming a manufacturing bank give an export company a loan of 500,000 and the interest on such loan is 25,000. The export company, they will pay back within 4 years. Out of that 25,000, 10% of it will be exempted from tax. Only 2.5 will be exempted from tax, while the balance will be subjected to tax. If the repayment period is between 5 years to 7 years, provided that the moratorium period is not less than 18 months, 40% of the interest received by bank will be exempted from tax. But if the repayment period is above 7 years, provided that the moratorium period is not less than 2 years, 70% of such interest on loan received by bank will be exempted from tax. So, number one interest that will be exempted from tax. Number one interest earned by bank that will be exempted from tax is interest on loan granted to a company engaged in manufacturing goods for exports. And this one has condition. One condition is certificate of export must be obtained from Nigeria Export Promotion Council. Number 2 condition is the not less than 50% of the good must be exported out of the country and not re-exported back to Nigeria. Number 3 condition is the rate of exemption shall be as follows. 1, any loan above 7 years. Any loan that the repayment period is above 7 years, provided that the moratorium period is not less than 18 months. Provided that the moratorium period is not less than 2 years, the rate of exemption shall be 70%. If the loan repayment period is between 5 to 7 years, provided that the moratorium period is not less than 18 months, the rate of exemption shall be 4%. If the loan repayment period is between 2 to 4 years, provided that the moratorium period is not less than 12 months, the rate of exemption shall be 10%. But any loan that the repayment period is less than 2 years, there will not be rate of exemption. All the interest will be subjected to tax. So number 2 interest exempted from tax is interest on loan granted by bank. Interest on loan granted by bank for primary agricultural production. when a bank give agricultural company a loan, such agricultural company, they engage in primary agricultural production. What is primary agricultural production? Primary agricultural production simply means rearing of animal, rearing of livestock, planting of crops. They are primary agricultural business. When a bank give them a loan, government want to encourage agriculture. They said such interest received by bank will not be subjected to tax based on the following condition. Number one condition is the moratorium period must not less than 12 months. While the interest rate charged by bank on such loan must not more than the base lending rate fixed by CBN. Number two is interest on loan granted by bank for primary agricultural production, which I said it has two conditions before it can be exempted from tax. Number one condition under this is the moratorium period must not less than 12 months. While the interest rates must not more than the base lending rate fixed by CBN. If that loan pass two conditions, the interest will be exempted from tax. But if the loan does not pass the two conditions, the interest will be subjected to tax. So that is number two interest exempted from tax. Number three interest exempted from tax. Interest on loan granted by bank to a company engaged in fabrication of local plants, manufacturing and tools. When a company is engaged in steel, they engage in steel production, melter. Government want to encourage people to invest in steel industry, iron. When a bank gives them a loan, they said such kind of loan will be exempted from tax if the moratorium period is not less than 18 months and the rate of interest charged by that bank is not more than the base lending rate fixed by CBN at the time in which the loan was granted. Another interest that is exempted from tax that is received by bank. Another interest received by bank exempted from tax. Interest on loan granted by bank to a company engaged in cottage industry, cottage, manufacturing of fabric and textile. That one too has a condition. The moratorium period must not less than 12 months. The rate of interest must not more than the base lending rates. Number five interest. Interest received by bank on federal government or state government security. Interest received by if bank subscribe for treasury bill, treasury certificate or development stock. When they pay them interest, such interest is exempted from tax. If bank receive interest from government security, either state government or federal government, such interest is exempted from tax. Another interest exempted from tax. Interest earned on foreign placements or dividends. If a bank have foreign placement, they have a foreign investment, they now give them dividends from such foreign investment. That dividend will be exempted from tax. or a bank has a foreign placement, they go and deposit money on foreign accounts. If they pay them interest, such interest will be exempted from tax, provided that the proceed, that interest earned from foreign placement, is brought to Nigeria through approved channel. It's not brought to Nigeria through back door, through approved channel. What is approved channel? CBN is aware. Through domiciliary accounts. Once they are aware, it will be exempted from tax. But if it is brought to Nigeria through back door, through dubious way, it will be subjected to tax. Another income or interest, you may be asked, what are the income received by bank that will be exempted from tax? They are all what I just mentioned. You start with interest. All what I just mentioned, they are the income too. They are the income. One for manufacturing goods for export, one for agricultural company, one for cottage industry, one for fabrication of local plant and machinery, one for foreign placement, one for government security. Dividend received by bank too is exempted from tax. It's going to be treated as what? Frank investment income. Frank investment income. What is frank investment income? Frank investment income are income that have suffered tax at source. What we mean by that? The tax that they have suffered at source will be treated as final tax. Before they pay it to the receiver, they have collected tax on it. Such tax that they collect from it will be treated as final tax. It's not going to be taxed again from the receiver. That is frank investment income. Example of frank investment income is dividend. Even in a normal manufacturing company, if a company receives dividend, such dividend is treated as a non-taxable income because it's a frank investment income. It has suffered tax as such. It will not suffer tax in the hand of receiver again. So all these are the income or interest earned by bank that will be exempted from tax. Apart from this, profit on disposal of fixed asset. If a bank disposes fixed asset, they make profit. Such profit is exempted from tax. This profit on disposal of fixed asset too, a normal manufacturing company or service company or trade company, if they dispose fixed asset, if they make profit, it's going to be exempted from tax. Why? Why profit on disposal of fixed asset is exempted from tax? Who can answer that?
Because of sales tax.
Because of what?
Sales tax. Again,
no.
CGT.
Because that money is capital in nature, and so it's going to suffer capital gains tax.
It's going to be suffer capital gain tax. It's going to be subjected to capital gain tax. It should not be taxed again under company income tax because it's going to be subjected to capital gain tax. So it will not be subjected to company income tax again. Because what we are doing here, all what we are doing, this taxation of specialized business is company income tax. Is company income tax. Do we understand? So all these are income earned by bank or interest received by bank that will be exempted from tax. Now, let's look at expenses of a bank. Expenses of a bank. What are those disallowable expenses of a bank? Generally, all those disallowable expenses of a normal manufacturing company, trading company, service company also apply to bank. Example, depreciation. Depreciation is also treated as a disallowable expenses under bank. General provision for bad debt too, also treated as a disallowable expenses under bank. Donation to unapproved body is also a disallowable expenses. It's also applied under bank. Fines and penalties is also a disallowable expenses under banks too. Aside from the disallowable expenses we have for general company that is applicable to bank, there are special disallowable expenses of a bank. These disallowable expenses I want to mention now only applicable to bank. It does not apply to manufacturing company. It is only applicable to bank. It does not apply to manufacturing company. Special disallowable of a bank. Special disallowable expenses of a bank. Number one, increase in provision of performing loan account. If you see it in an expenses of a bank, they make provision for performing loan account as part of their expenses. You are going to disallow it. You are going to add it back to their net profit. Increase in provision for other assets and account receivables too. You are going to disallow it. Increase in provision for advances under finance lease. If you see it in an expenses of a bank, you disallow it. Increase in provision for diminution in value of investment. If you see it in an expenses of a bank, you disallow it. Apart from general disallowable expenses that we have. Increase in provision for off balance sheet engagement. You also disallow it. Increase in provision for gratuity. If you see in an expenses of a bank, you disallow it. Unrealized exchange loss is also disallowable expenses. For exchange loss, unrealized exchange loss is disallowed, while realized exchange loss is allowed. Unrealized exchange loss means provision for exchange loss. You have not made that foreign exchange loss. You have not made the loss. You are just providing for it. It's not allowed. It's a disallowable expenses. The realized exchange loss means you have made transaction. Actually make that loss is disallowed. Still on unrealized exchange, we have realized exchange gain and unrealized exchange gain. Realized exchange gain is taxable, while unrealized exchange gain is non-taxable income. So that is it. All these are special disallowable expenses of a bank. Increase in provision for performing loan, increase in provision for other assets, increase in provision for advance other finance lease, increase in provision for diminishing value of investment, increase in provision for off-balance sheet engagement, unrealized exchange loss. So that is all we need to know under bank. That is all we need to know under bank. So, ladies and gentlemen, by next week, we continue from bank by solving question on taxation of bank. Any question, any issues, any observation before we close for today? Any question? In the absence of no question, we can call it a day. Thank you very much. Thank you for having me. So what we discussed today is taxation of specialized business. And we said specialized business, we group them into various headings, various business line. Airline, shipping and telecommunication company is the first. Taxation of bank is second. Taxation of insurance is third. Taxation of unit trust and pension fund is fourth. While taxation of real estate business in Nigeria is fifth. This night, we have discussed taxation of airline, shipping, and telecommunication company. We have also looked at taxation of bank, but we have not solved question on taxation of bank. We have solved 2 questions on taxation of airline, shipping, and telecommunication company. Taxation of airline, shipping, and telecommunication company, we look at the step involved in computing their tax liability. We mentioned the step. We said we need to get our global income first. When we get our global income, we get Nigeria income. After that, we compute global adjusted profit ratio. After that, we compute our global, after we get our Nigeria income, we compute our global adjusted profit. After that, we compute our global adjusted profit ratio. After that, we now compute our depreciation allowance ratio. From that, we can get our Nigeria adjusted profit. After that, we get our Nigeria capital allowance. When we get our Nigeria adjusted profit and Nigeria capital allowance, we now get our total profit. How do we get our total profit or taxable profit? Nigeria adjusted profit less Nigeria capital allowance, we get our total profit. From there, we can now compute our tax liability. How do we compute our tax liability? We compute company income tax, we compute education tax, and we compute police development. Our company income tax depends on the company turnover. If the turnover range from more than 25 million to 100 million, the company income tax rate is 20%. Why? If the turnover is more than 100 million, the company income tax rate is 30%. Education tax rate depends on the year of assessment. If we are given 4 years of assessment, education tax rate is 3%. If we are given 2022 year of assessment, education tax rate is 2.5%. So, ladies and gentlemen, thank you for having me. Have a good night. Thank you very much.